Hi, everyone, and welcome to this panel. Let's see, what's the title? Tokenized treasures. I call it the pre-Stephen Bartlett panel because like everyone's waiting for Stephen. So this is the pre-one. So alternative assets, they really sound very appealing to us, but we don't understand the challenges or obstacles that come with alternative assets for all stakeholders. They're less liquid, they're less maybe transparent, they're less accessible. There's not a lot of information there, but slowly but surely, tokenization is promising to change all of that. We do speak about democratization, we do speak about lowering barriers to entry, but what does that all mean? I appreciate that we're gonna keep this as light as possible, as non-technical as possible, and maybe shed light on the added value of tokenizations for alternative assets and investments. I'm gonna leave my panelists introduce themselves the way they want, because why not, yeah? Please, we'll go with you, Alejandro.
Thank you. My name is Alejandro Gutierrez. I'm the co-founder of DeFactor and the CEO of DeFactor Labs. DeFactor Labs is an on-chain marketplace that is bringing liquidity to traditional financiers and is trying to tokenize that debt in order to help SMEs around the world.
Hi, everyone. Thank you for braving the heat and coming to this last panel of the day. My name is Sophia Shluger. I'm the Chief Commercial Officer at PVO1. At PVO1, we put bonds on blockchain, so somewhat similar. Our mission is to build a debt capital markets on which a healthy digital asset ecosystem can thrive.
Hello, I'm Mike. I'm part of Luxury Hotel. We are tokenizing our membership and creating a central hub in the south of Portugal for entrepreneurs, tech people, and the crypto curious to network in the south.
Hello, my name is Weiwu from Smart Token Labs. We do what he does.
I love that, like competitors.
No, we're partners. So we tokenize stuff, but we're technical solution providers. We don't issue membership tokens, so yeah, not in competition. So what we do is we add functionalities to tokens to make it more worthy of investment. So think about smart cars. If it can automatically rent itself, it's more worthy.
Thank you very much for being with us. So let's kick off this panel with the first question. So let's identify to the audience what are the fundamental components of alternative asset tokenization. Maybe you can take us through a journey, Alejandro and Weiwu, on where it all started. Where was that boom and where we are today?
So a bit of background, I started investing in Bitcoin really early in 2012. And I went to Australia's largest bank, Commonwealth Bank, as a blockchain architect, working on creating blockchain-based assets, exactly what I'm talking about today. And there are a few reasons to do that. One is that assets in a single platform doesn't access the maximum market, therefore doesn't have the maximum value. And by single market, I mean on the blockchain, there's no entrance. So assets existing on the blockchain is already on the market in the blockchain. Well, normally you have to list the assets in the market, and it depends on the market reach. You might list the assets in multiple markets. So that creates friction. That's number one. Number two, the second reason we want to tokenize assets is because the use cases usually are connected with the assets in an electronic way. So a simple way is car rental. So the use case is that somebody's go to the car and drive away the car. That's the value. But the sales and the purchase of these assets are blockchain tokens. So both are electronic, and you can maximize utility, therefore maximizing the value of underlying asset by having a blockchain connected system. So there are two reasons. Let me rephrase. First reason is you want to access the maximum market, and you want to have it already on the market, not to be listed. That's why blockchain is good. And second, you want utilities to be connected to all the IT systems that uses it.
Amazing, Alejandro.
So, like this hype now on the tokenization that we are seeing here has been in the grasp for the last 5 years probably, and this came out of the real world assets, right? And I say, okay, how we can just do the same or try to replicate what is happening with digital assets, but with physical assets, right? In 2019, the guys from MakerDAO, they were kind of the pioneers on this space. We were one of the first teams actually work with them tokenizing real-world assets for lending purposes and minting DAI in exchange for locking these assets and for them to have that as collateral, right? The idea at that point was actually have an over-collateralized lending, and instead of having digital assets backing up loans, you have actually invoices, or you have goods, or in like any other form or instrument that you can tokenize and you can use as collateral, right? And from there until now, like you're seeing about all sorts of different assets, tools that are tokenized, right? But I think the important component here, right, is that the ecosystem is starting to realize that if we want to just have some proper scalability and we want to actually solve real problems, well, we need to just go into the real world.
Absolutely. Well, Sophia and Michael, so this question is for both of you. Why now? Tokenization is not something new. It's not 5 years old. It's much more than that. But what's happening now? What's happening in the market, or why this sudden thirst for tokenizing everything, and especially in real world assets?
Yeah, it's a great question. I have a little bit of a history lesson here. I'll just walk you through, complementing what was said earlier. So tokenization in real world assets is not new. It's been around since 2015. You may remember the STO, the security token offerings, and a lot of it focused on real estate. So the fractionalization was very innovative, but the problem was there was no demand and no liquidity. And then you have to think about what else was happening in the crypto market at that time. We had the ICO boom, and then shortly thereafter, we had DeFi summer. So it was a confluence of different things that occurred that sort of put tokenization on the back burner. And what we're seeing now is in the last 12 to 18 months, a lot of new players coming in and building. So for example, you've heard KKR is tokenizing private equity funds. Franklin Templeton is offering, short-term and medium-term treasuries. You even have the news of the California DMV is tokenizing car titles. So it's happening. And I think some of the variables that have coalesced to make this happen are, better scaling that was mentioned, better infrastructure, and also the UI UX. One last thing I want to mention is stablecoins. They're the OG of the RWAs, right? And we're seeing an explosion in issuance of stablecoins. PayPal is issuing a stablecoin. It represents 120 billion in the market currently. And that's growing at something like a 40% year-over-year CAGR rate. So it's all of these different variables that have come together, and tokenization is really sort of now in the forefront of everyone's mind, particularly given all the benefits of it in terms of increased transparency, lower cost, efficiency gains, et cetera. Just this year alone, the market has 6x'd from January to June, right? We have something around 600 billion in RWAs across art, real estate, fixed income equities, and that's expected to potentially grow to 16 trillion by the year 2030, according to BCG. So it's on the forefront of everyone's minds, and personally speaking, what excites me most about it is the way in which we can get the more traditional financial players and the institutions to come into the digital asset space via these real world assets.
So basically the marriage of tokenization and blockchain enabled all of this as well, yeah. Please.
And to add on that, I think the interest in tokenizing assets now, there's a lot of people that made money in the last crypto booms, and people are starting to look at where can they diversify their investments from purely speculative digital plays into more things that are backed by real world assets. So one of the things that we're doing with our tokenized membership is offering real world utility. I know it's a buzzword, but as technologies are advancing, although it's not the newest of technologies, the interest in more secure, less high-risk plays are definitely growing as people are looking to secure part of their profits or part of their investments.
Actually, let's stay on that, and if you can tell us more about this token-gated membership model that you have. I'm really interested in this. I've never been to Algarve yet, but next time you're gonna, everyone's invited to. No,
you'll all be my guest.
But it's really interesting because this is revolutionizing, the hospitality industry. So, and you're pioneering in that. So, walk us through the experience as well. Like, what was in your mind when you were like, oh yeah, we're going to make a crypto hotel? What went there?
Well, the reason why we're doing a crypto hotel in the south, in the Algarve, is basically to create a hub for entrepreneurs and tech people to find a place where we can network. The value in these IRL events can't be understated enough. In other large cities, Porto, Lisbon, there's already established communities, whereas in the south it's very fragmented. There's lots of entrepreneurs, lots of people who live in the phrase or live in isolation as digital nomads. So creating a place where people can coalesce and network is valuable in that regard. The reason why we're tokenizing the membership is because through that we can get as much information or as little information as they want to give, and we can streamline processes. At a hotel, for example, traditionally you need to go in, wait at the checkout, show your passport, identification type things. Whereas with modern technologies, using NFCs, for example, they can pre-register, just have simplify the entrance to the hotel, and just if they give us the information, for example, they like the room temperature at a certain degree, or they have a certain PFP they want displayed on their wall, we can personalize the experience exactly to our end user, and therefore create or optimize the user experience.
Amazing. When is the opening? When are we all invited to the grand opening?
You're all invited now. But currently it's a renovation project. We'll be having the spas and bars fully renovated within 12 months, and then the room rentals, the rooms will be done in about a 24-month period. But before that, we are doing events because it's a hotel that looks nice as is.
It's next to the W.
It's literally, it's like 100 meters from the beach. So the
You're
W
all
hotel.
invited, guys.
You're all
promise.
invited. Yeah, there's no beds in there yet, but if you're sleeping on the floor, then be my guest.
Thank you very much. Weiwu, let's move a little bit about how tokenization is not like a one-click affair, how it's a very long process to you, for example, at Smart Token Labs. But how much should the Web3 user or like the end company should know about this, and how much should they be involved in the whole process?
Honestly, I think tokenized assets in terms of what do you call smart tokens, which are tokens not just hold on a blockchain, but you can use that for utility. Like if you have a hotel room, you can open the door, a hotel room token. So this kind of thing, honestly, I think this is going to be the biggest thing ever in the blockchain space, and probably in the internet era as well. Because if you think about the application space, cryptocurrency solves a few niche problems. And then there have the speculative token, NFT, which is a financial product. And then the only thing that can make fundamental change to the web has to be something related to every consumer and business. And that's where blockchain can enable smart token is really relevant. So today, what we use today, a lot of things can be tokenized. I mentioned the smart car can be tokenized. It potentially allows you to get the insurance one click. And it potentially allows the insurance market to be more competitive because every matching is done automatically. It probably allowed the smart car to be automatically renting itself when you are not using it. Or even if your car has a broken down accident, it can report to claim the insurance automatically, because token can bridge the trust and can work in between the vendors, as already shown is the power of the NFT tokens. So it's going to be huge. But as you mentioned, that why it's not a one-click effort. So token is special in a way that it's not a very good core product. So by core product, I mean, if you have a smart car, that's a car. You can drive it, that's the core product. That's not the whole product. When the user buys a car, they expect maintenance. They want to make friends with other car owners in the region. They want to know how to charge their car. And they want to have a consistent service and insurance, as I mentioned. So these things are not the core product, but it gives the user actual value. And in many cases, the whole product is a few times greater than the core product. So one of the examples being the flight ticket. The flight ticket is only like $50 from my home in Spain to this place. But it is connected with the hotel booking, and my plane was delayed. I actually arrived 5 a.m. So imagine if I am delayed further, then the hotel rebooking cost is going to be a few times bigger. And if a smart token is at work, then it can facilitate this by a temporary contract agreement between the hotel and the airline company. And I don't have to submit reports of why, like, I'm honest, like this is really an airline plane delay. So there are many cases where the whole product have more value, but it depends on partnership. It depends on the token issuer is able to have other companies related to this industry also support blockchain. So you don't have a case where you convince one guy, only one guy, to issue a smart token and then market as fundamental change. It doesn't happen. You have to convince a few guys to move at the same time. And many of them will not move unless this is industry that is dying for it. So unless we cross this bridge, it's not going to be ready for everyone. But what you can do now, as you mentioned as consumer today, what you can do now, what we can do, you can go to our technology and follow this, and we probably will do a token sale too. So that's a good starting point.
Thank you very much. Okay, Alejandro, I was going through the website and I saw like the word community written like 17,645 times, and it was very nice because we often go too technical in these panels, but we almost forget that the core or the end user is the community, and how are you building that in dFactor? Okay. And I also would like to know more about some successful projects, tokenization projects, so people can understand better the use cases.
Yeah. So yeah, community is key, and I think, well, for us, we are a DAO in Switzerland, which means that we have a token, and that token represents actually or gives that power to the community to just have a say and decide kind of where the project is going. And I think that's critical for us. We want to just build, in a way, a decentralized project where people can come and just build on top of whatever we're doing. I think that's probably the most efficient way to just create that knowledge and that transfer of knowledge about like in the ecosystem, right? One of the key components when you're talking about community is allowing people to just see their own assets in a completely different way. And that's something that is coming, or we believe that is going to be a trigger or a consequence of the evolution of tokenization of real-world assets, right? Why? Because there's a lot of assets that at the moment are not liquid, but this technology will have the chance at some point to just make them liquid. And people will start actually understanding that there is value on the things that they have, and just seeing or having the chance to just maybe even fund themselves without the need to actually just go into third parties for credit, just as an example, right? Like we were experimenting with, for example, whiskey. Like our company is in Ireland, and there's a lot of distilleries that have liters and liters of whiskey that have tremendous value, but in the traditional space, it's completely liquid. If they go to a bank and say, please, can you give me a loan against these? 99% of the times they're going to say no. We don't know how to evaluate these. We don't know how it works. We don't know how the custody. But the technology actually is allowing just to tokenize it, have custody, get the community behind these projects, because there are projects that are interested for people, and then just back up and provide that capital and that liquidity that the small companies want, right? So you are creating these alternative sources of liquidity that before they did not exist. Now, from the
are you going to serve that whiskey in the hotel?
Yeah, we can. And wine. We have here, there is some partners that we're doing some wine project, Andrew, right there. So yeah, same story, like because all these assets, they have value, right? And the value can be extracted. And this technology now is allowing for that. From key points and achievements, in June we launched Alpha, that is a fully regulated, institutional grade product. So it was the first institutional grade and fully regulated product or DeFi product in Europe. We are doing all these through a tokenization vehicle, an SV in Luxembourg, backed up by a BaFin regulated, BaFin compliant. And what we're doing actually, or trying to just get institutional investors, well, because one of the key components or one of the key needs at the moment in the space is liquidity. There's no liquidity. So we need to bring the big boys to play with us. In that case, they can pour the cash. Because at the moment, all this is fantastic. There is a lot of hype, But unfortunately, hype is not equating to liquidity in the market. And as community, we need to just do something just to attract these partners, to just put the money in.
Yes, thank you very much. Sophia, I'm gonna go to you. So we have a lot of players in this space, especially everyone's talking about tokenizing real world assets. Let's tokenize this, let's tokenize that. But what's significant about PVO1 and how does like blockchain, the debt market and crypto come into place?
Absolutely, thank you for the question. Well, as you may know, in the traditional financial markets, the fixed income market is massive. It's one of the largest. And so we think it's really ripe for disruption for all the benefits that were described earlier. So our company is really focused on a novel way for issuers to access capital and for institutional investors to find high quality debt offerings. So there are a lot of different players out there tokenizing equities and also fixed income, but everyone's structuring it a little differently. I think what's unique about our platform is that we're offering 100% direct one-for-one exposure to the underlying asset. Basically, it's a non-custodial platform where we would mint a token and you would get direct exposure through your USDC with that underlying short-term treasuries asset, for example. So basically what it is a digital twin of the activity on-chain with the activity off-chain. So you can stay on-chain and get access to these risk-free US Treasury yields in a seamless way via an ERC20 token that is actually fully transferable. What's really innovative about that is that you can go on and use that as yielding collateral very easily because, again, it's transparent, it's on the blockchain. And the way in which we're setting it up with our licensing in Bermuda, it will be via a bankruptcy remote SPV. So basically, you'll have a debt claim against that SPV. It's as neat of a process as one can possibly do, marrying the on-chain and the off-chain worlds together. And we're very excited about that because, as I mentioned, there are many stablecoins in the market and growing, and many of them are not earning yields. And particularly now in this current market environment where DeFi yields are much lower than what they were during the bull market, the risk-free yield of US Treasuries, for example, looks very interesting. Last thing I'll say is, we're not stopping there. We're obviously thinking about corporate credit and other sovereign debt and other debt products. So we're starting with sort of the risk-free, treasuries, but we're going to grow and facilitate issuance across all of these different debt securities. It's very exciting, and we're really excited to collaborate and help the whole industry grow together because we need that liquidity, we need institutional participation, and I think we all want to get smart and get people on chain and also benefiting from yields that are available in the real world.
Can you think of other challenges than liquidity as well? Because it's all rainbows and butterflies, yes, but we have a lot to talk about, and it's also good to talk about the good and the bad in every industry or like.
Yeah, I mean, I think there are a lot of issues and challenges. I mean, obviously, at the moment, we're catering mostly to a crypto-native community that are already active on-chain with wallets that hold USDC. Obviously, in the future, we want to be multi-chain. We'll cater not just to USDC, but USDT, perhaps other stablecoins. But generally, I think it's a mixture of, a lot of the crypto-native players like to participate in staking, is what they're comfortable with. They adopt this ethos of decentralization. So coming into sort of a real-world asset investment is a bit, contrarian to how they're structured and built. There's other things, regulation is one piece of it, doing this in a regulated fashion versus an unregulated fashion. Education, understanding the benefits and why, you should think about the ROI on your treasury as opposed to just, aping into a staking pool that you're familiar with because it's how you've always done business. There's other challenges that have been mentioned before, liquidity, I think scaling as well. We're improving upon that. It's not finalized. And then obviously a piece of interoperability. We're still, a long way to go until this can really scale to size. But I think we'll get there. It's just a matter of, putting our head down and building right now.
Absolutely, absolutely. And I think this bleeds into everything, interoperability. All of these challenges that we're talking about are like more of a high-level Web3 challenges that are bleeding into every vertical. So
if you allow me, actually, there is a key one here, right? That is how are you linking that digital asset to the real world asset? And that's something that is not solved yet because we still need to resource actually to traditional vehicles like SPVs and traditional agreements. So in that case, you have some resort if there is a liquidation of something happens. So that's something that as ecosystem we need to just work on. I don't think that's fully solved. I think they are, from the regulatory perspective, like the digital regulation that came out of here UK was fantastic, because I think it's a first move into that direction, but the custody and pricing of real world assets needs to improve dramatically.
I would also just mention like the accurate valuation of tokenized assets, right? Because a lot of these assets are illiquid and have historically been non-transparent. Let's take the art market, for example. So having frameworks for that so people really understand the value of what they're buying with the tokens.
I wanted to have an AI question just because AI is the hype right now, but I'm not gonna, I'm just kidding. My last question is to everyone actually. So we're talking about an industry that's expected to be at 16 trillion in 2030 according to BCG. So where do you see the trend going? Where do you see the long-term impact of tokenization on both alternative investments and the blockchain and crypto industry? For all of you guys. Do you want to start?
So, as you say, it's a growing market. I think the underlying, like the how we're going to get there, it fundamentally lies with education to regulators. It's still, the whole crypto space is still, although it's not new and it's not new to us, regulators, they often lag behind in terms of their policy regulations. So as crypto companies finding efficient solutions to clunky systems, for example, like selling property, that market, tokenizing that, and using real use case examples and demonstrating the fundamental technology that we are working with, demonstrating that, showing that there's more to crypto than hackers and hoodies. There's actually, technology that can benefit the banking system, governments, and the general users.
And this, if there's no regulation, people are just going somewhere and registering somewhere where there is regulations and legislations are in place. And a lot of countries, maybe on like a high level, we're talking, they're not thinking about this reverse brain drain. We've seen a lot of brain drain from the East to the West. I hate the East and West narrative, but it is what it is. But now you're seeing more of like brain retention and reverse brain drain, because a lot of Western companies are going to base themselves, for example, in Dubai, where legislations are a little bit clearer. But yeah, you have a lot of talent that are seeking just to leave and base themselves somewhere else, and that's not good for the economy, is it?
And just on that, you're absolutely right. And the countries that don't adopt the new regulations are going to be left behind.
Exactly.
So to avoid that, I think they need a few use case examples, like innovative countries like Dubai, Singapore. Portugal is very crypto friendly, although it's becoming slightly less friendly.
Are they following the Americans? What's happening?
Thankfully not that far, but they do. I think they are receiving a lot of pressure from the EU on being too favorable, not giving, and then there is a brain drain to Portugal. So lots of European talent is moving there. Other countries are a bit fed up with that, so they're like, okay, slow down, be less friendly until we can figure out how we can be more friendly.
Weiwu.
So we're talking about, given this market size, what impact it's going to have. Let's rewind a bit and think about internet. Internet was initially proposed as information superhighway. So when we think about its impact, we are thinking about how it impacts information business, how would it impact newspapers, periodicals, and how the states emit information, how the library works. But that's only a small niche of what the internet changed. And today we are using social network, for example, which is not in the purview of internet in the beginning. And we have a lot of, we have huge e-commerce. I don't even have to emphasize how big it is. So now, given that, today we are looking at the very large assetization market, and it's very easy to fall into the same trap and think that the impact is going to be on the financial industry, but it's not. So imagine that it would do to the business. If the business is able to focus on their core product and as a token, and then connect to all of the related services through tokenization. Then they will be less depending on affiliated marketing. They might less take a consultant, for example. A therapist only spend half of the time dealing with patients. Most of the time he's socializing with other people so that people recognize him, because there's no therapist eBay, there's no therapist Amazon. But with tokenization, it's possible to integrate this to everything. Imagine a therapist service being integrated into a wellness app. That's going to change how people do business. That's going to change how consumers use it. And that's also going to change how the apps are designed, or even the websites are designed. We today see websites as a representation of a business. Like if you go to Amazon, it's Amazon business. We don't see website as a media where all of the services are integrated to present to the users. That's why we keep switching between tabs, because none of them solve our needs. Consumer behavior is going to change. I think it's going to be huge, everything.
I'll just say from the financial services side, financial services, 12% of global GDP. Larry Fink from BlackRock believes that tokenization is going to fuel, the next generation of the capital markets. And I believe that. As you think about it, the current systems are very opaque. They're rent sinking, and they need to be disintermediated. A lot of these systems were written in the 70s and 80s, and most transactions on average go through something like 2.6 banks and take 7 to 10 days to settle, right? That's, why would we would never build a system today, given the technology we have, given, what we know. We have a 24/7 system that runs on global rails, and that's really the promise. So if we get, these real-world assets on blockchain, I think it's the most promising use case for blockchain that's ever existed, frankly.
Ooh, big words, though.
I fully agree. I think it's the way that DeFi realistically, or DeFi technology, is going to scale. Like if we don't go and we don't take our head outside the DeFi bubble, and yeah, it's cool. It's really interesting, right? Like there is a lot of experimentation, but if we're not solving real world problems, it's pointless. Like we need to just focus on actually solving problems, right? Like and this is something that is pretty interesting when you compare what is happening in Europe, what is happening in America, compared to what is happening, let's say, in Africa or South America. Those guys are miles ahead. Miles ahead. They are solving real problems, right? And one thing that is funny, I remember being there for DevCon last year, and one of the guys said, like, look, what you guys are doing in Europe is cool. Yeah, you're experimenting, you're trying to just make things better. In here is need, like here is necessity. And necessity, when you have necessity, is a completely different beast, because you need to solve problems. Like there's a reason, like Argentina, the adoption in Argentina in crypto is insane. Why? Well, because if you are losing valuation of your currency 50% in a year, that means that your son probably is not going to go to university.
Yeah, well,
so
absolutely. I see the necessity and the need. So
doubt.
I'm Lebanese. I was in Lebanon for a holiday, and I was doing like this small research, and I was baffled by the number of people who use crypto. And we're not crypto or Web3 literate people, but the necessity, because we also, our currency lost 90%. They were competing. So people were like, we're not going to trust the system anymore. Yeah. So they went and saw this alternative solution to this problem. So absolutely.
Look, and I think we have the opportunity actually just to change the system that is broken. It's broken in a lot of countries, right? True. And we have an opportunity. And one of the things that I always say is, like, it will be really sad if in 20, 25 years, we're looking back and saying, like, ooh, this promising technology ended up being just facilitating and optimizing a system that it doesn't work and making more money to the traditional institutions that are already making a lot of money.
I hope in 25 years we're not sitting together and saying that.
No, that's why we are retired.
I think, can we take like a couple of questions if there's any? Yeah? Perfect. Yes.
I can talk very loudly if you want.
Yeah, perfect.
Yeah. One thing I wonder a lot with tokenizing real world assets like real estate is liability, right? So regulations can change, but if you tokenize a house or a hotel and something goes wrong, but the ownership of the hotel is shared among 10, 100,000, 1 million holders, who's liable for damages or culpable for damages?
Look, we explore in the beginning of the factor and our journey in tokenization. Well, everybody was talking about tokenizing real estate, right? And it's like, yeah, pretty appealing. And quite fast, we realized that regulatory from the regulatory perspective, it's a nightmare. And it's a nightmare because every single case, or depending on the representation of that token, you will have different complexities on how you're going to structure deals. Are you the owner and are you, or you have the rights over the property? Or are you going to actually just take the futures of a hotel and then you just get only, well, that will be a security token and that will be representing actually benefits and yield in the future. So, and then if you have on top of that, the fact that the regulatory perspective is different in every single jurisdiction, then you're starting getting into really complex territory. And that personally does, yeah, I think real estate is a fantastic opportunity. I think we are far from it actually to just make it in a scale way.
I don't think so.
I do. Oh yeah, I think credit is way easier to do.
I think the other issue is it's very fragmented. We don't have a universal standard or an oversight body to sort of give guidance on best practices. So this is part of the growth process. But ultimately, to answer your question, and I'm not an expert on real estate fractionalization, but it will come down to the regulatory framework, but also how that particular project is structured legally. And we need to make a lot of inroads in terms of clarifying that jurisdiction dependent.
And yeah, just to add on both those points, it completely is down to the regulatory bodies of the countries. One of the issues we've had with the hotel, our first idea was to fractionalize the entire ownership of the hotel, but then our overpriced lawyers, they suggested to us, don't do that. That's a security straight up. So that's why we tokenize a membership instead of that. So the only way that we've actually been able to sell any rooms in the hotel is through a long-term lease. So we remain the owners per se on a Web2 paper, but we have a smart contract NFT that gives ownership of the room via a lease.
Perfect. I think we're running out of time. One more question? No? I'm sorry. One more? Yes, please.
My question is to do with when you start talking about tokenization of real-world assets, there becomes privacy implications. How does the panel consider that? Because some information for investors, some information for sort of positions that different people have, a public blockchain is a public blockchain. So are we considering privacy pools? Yeah, that's the nature of the question.
Well, all of the tokenization platforms, I think, are approaching it differently with different criteria and motivations. Yes, I mean, obviously, if you have a wallet address, you're on Etherscan, let's say, and but you're pseudonymous, right? So we don't know exactly who you are, but we can see what's in there. I think that will boil down to on an individual or institution by institutional basis. It is a very good point and one that needs thorough consideration. I think a lot of the platforms are thinking through how do we make this as efficient and as useful, to the market, and then those sorts of important, considerations will come a bit later. But at the end of the day, it is a market, so it's demand-driven, and people who are uncomfortable with the way the privacy is set up obviously probably will not participate in that particular platform. But it's one that definitely should, I'd be curious to read and understand it better.
Yeah, that's one of the first questions that our clients ask, okay, is this going to be public to everybody? And the answer is no. There's enough technology now that you can just choose what you're going to be disclosing in the blockchain. And there, you can play with whatever you put on chain, whatever you put off chain. And when you merge both, then you have a full visibility of what happens, and you can just gate the access of that information to people, right? So there are ways to do it, but yeah, I know this is a concern. It's especially when you're talking, okay, you're going to be disclosing all my information out there, and everybody's going to be able to see it. No, but it's just the visibility perspective. It's funny, right? Because the technology, DeFi, the things that make DeFi so attractive sometimes are the ones that make it not that attractive, right? So it's just playing and balancing both.
Yeah, and there's also a race between the private and the public blockchains in terms of which of the two are going to win out on the RWA tokenization. And we see a lot of players, the big institutional guys, JP Morgan, Goldman Sachs, they're building their own private blockchains. But my take on it is with anything in technology, network effects win. And so it's the public blockchains that are going to win over the private over time.
Love that. Thank you very much, everyone, for coming and for listening. Thank you to our panelists, and enjoy tonight.